10:11 a.m. Pacific Standard Time, 10/1/2011. We're gathered here to look at the Nasdaq 100 Volatility Index with our MMTs, and what we are doing is that we are seeing how that fear is building momentum, and that in the last 10 trading days we have come higher here. And here's your areas of interest in this public platform. Here is you're about to break these highs, but notice how you're closing on a high. See where the reversal was before, is we're challenging that, and we're going to talk about the subject pre-market futures. If they were to be down, let's say, to meet the qualifier, futures were down 200. You've seen that happen before many times. And what we are talking about specifically is capitulation, market price action capitulation. What does that mean? It means that the fear indicator would blow off to an extreme high, and you would come down here on the Nasdaq 100 daily chart right here. This is a daily that you would gap way down here, or gap below it. And remember, the worst quarter just ended. There was a huge amount of protection called put options were being bought at a high premium to the market. So we started to see on Friday where a lot of retail pricing started to come in on that put side when we sold off on Friday. So people were paying a premium. So a capitulation would be in the criteria that you would gap down, and then the selling would just continue and you would break these lows. That's your qualifier. In scenario trade management operation A plan. Okay? The opposite side is that and this is a weekly now. This is a weekly fear indicator, okay? So you can see the 2 weeks, and you can see how they're breaking up here at the highs, and you can see that increase in fear is already there. What we're measuring between the public buyer and seller is that common fear factor emotion that comes into play in the public buy and sell transaction model, and how people's perceptions around the world are going to be calculated. So when you have a capitulation to a downside, is you have to open up big down. The qualifier has to be an emotional event, could be a bank going under, something like Lehman or something like that. So there has to be a qualifier in that. And that would be that something like the Greece or Italy or Spain, or doesn't matter which one of them, but which one are they going to avoid defaults or not in their banking systems? And how are the 17 countries coming to their conclusionary decision processing as to what that will look like? And you know, what kind of models are they going to use to have their societies prosper and that things turn around? The capitulation here is that on the fear indicator, when you're going to put a confirmation bottom in, you are going to capitulate on the opening. And on this is a weekly now. And you can clearly see over here that there are levels at as high as 80. MMTs, what it really stands for is you would gap up into areas. There are key areas in here that, number one, you can see the spikes here, and then you get an immediate reversals. That's what you're going to be looking for, okay? And that would actually happen on the opening bell, okay? Because it would. And to verify capitulation, it has to be within the 21st 20-minute opening bell rule. If it's beyond 20 minutes, it does not qualify. And once again, let's be clear about the qualifiers. It has to be a major headline event, and it would have to be where the current market closed on Friday. And should there be that big gap down, then we would be looking for that capitulation to the downside, and then how they actually go through their big reversals, okay? Because they do. And that's one of the things that we're going to be looking for, is where do we peak at a high, like when this high peaked here, and then bam, that was it. This is back in 2008, and there was a capitulation in here, you know, for what it was. And what are the circuit breakers set at right now on the exchange model system? And what curves have these people made with them? Okay? And yes, here's a daily chart in our SMF platform. Here, let me price it out. Kabingo, there it is. Okay? And here it is. Let's diamond this move out. This is the Nasdaq 100 here. And you can see in our platform, it's a market maker platform versus looking at that standard chart. But what you're going to be looking for is that major fear, and how you're going to break these lows right here. And if we're going to break these lows, you're going to gap below them, and this is what it's going to look like in your platform. And all the diamonds are going to be closing at the bottoms. They'll be going like this all the way down until they finally get to the bottom again, just like they get to the bottoms here. See, they get to the bottoms, but see how they reverse and make their, and you were trading MMT platform, you're going to see big diamond, huge diamond MMTs. Here are the weekly diamonds, and then here is the daily. So on the capitulation, what we would be looking at is what part on this weekly chart MMTs would that come into play. And we can clearly see that back over here is where the lows were. And we know on our platform exactly what each one of these delta lines are. And one delta is 98.76 is one delta each one of these lines. Yeah, they are. Right here, 98.76. Period. And it's a weekly. Okay? So each weekly move in a 5-day compounded area can equal that one delta. And it's absolutely correct. Look at them. And that's between the buyer and the seller in a weekly 5-day compounded basis. Capitulation would be that you would come back here at 2040 or so, and you would have to meet the criteria. In the first 20 minutes, you'd have to have, number one, a major event worldwide in the banking system, and there was a huge gap down. That is where breaking the lower support levels is where the capitulation may start in the price action. So we want to be very well aware that each one of the lines starting Monday are 98.76, and that's weekly movement. That's compounded by 5 days now. And right now, the major 2-week reversal is very clear at this major diamond weekly area here, where we were breaking up and breaking out. But now we're closing lower on the weekly SMF market maker diamonds in price action. Weakness is being built. should we capitulate now, you would want to see at least a delta gap down. At least one intraday, you can go a delta. In this case, it's $1 delta movement. Okay, all right, 98.76. And to verify it is that the weekly bar that develops does not go above the bottom of the previous week's bar, unless it's something about neck to neck with it, like this right here, MMTs. And then you start right down. You shot right up into volatility, and volatility was to sell the top down trade, and we have all the live entries and exits from last week in that top down trade. Okay, now granted, a capitulation is where do we end up where we get a big gap down with a big disturbance worldwide that would create it to qualify. Then where the electronic stop market orders on the opening bell below Friday's close get automatically triggered when those markets are electronically made. Then thereafter, price action continue to go down further, and then there would be a reversal on a 3-minute chart, and it would look like this. These are weekly breakouts, but this is the lower end of this market over here, where the breakout started, to the highs, to the reversals, all the trades that we've done. But notice, we're going into a calendar earnings season. A capitulation is the subject, and that's opening up down here, or down here, and then working your way right back up to sell. I will go into an example of, and here's your daily. You would see the gap below these daily diamonds on the opening bell in the daily chart here in the SMF platform. Yes, you would. Not only that, your fear indicator, Nasdaq 100 volatility index right here, we would be taking a look at what would be the measurability of that fear should this case scenario take action. Is how do we get it way up there, and then on an intraday level you start to see long wicks like that, and red bars coming down on your 3-minute, your 60-minute, okay, and you would see a big reversal. That would mean that the bottom of that capitulation at those teeny levels would automatically ascend in value, and that would be where the turn would be and the wholesale bids. I'm going to point out the 21.55 call and the 21.55 put. And making a market in the market maker atmosphere when there's nothing being traded is that there was a print that got created right here at a wholesale bid, volume of only 5. And what SMF does is teaches you how to get that entry. Then when the reversal and the fear indicator here on the weekly level was breaking out Friday right here, closing on the high, that made this premium go $20 above it, and you as an SMF market maker could say, oh well, here, I'm going to control the whole pit around the US. Here's all the buys and here's all the sells. What can I do? Well, I can come in here and put it out at 99.5 and try to get them to take it. I'm still making money because I was a market maker over here. Then when the Nasdaq 100 sold off, and as the fear indicator here was mounting on its weekly high close at this trend line right here, which is right over here in this area, right here in the video, and we closed on the high. So when you close on the high, this cost to hedge yourself, the premium, the put protection, increased significantly in value from the 76.50 put. So later in the day Friday, this is whoever created and only used a volume of 5, created a market, because now the bid and ask is 97.40. And you could say, oh, well here, bam, 97.40, you own it. But you would have to know the directional price movement in order to accomplish this goal. And at the very same time that was going up in value, you could see here you can see here that the last print was 81.20 here. But now it's 71.30 bid to the last low print with the 75.20 ask. Okay? The thing about this is that the close was 92. It's already, if you take 92.80 from that other day, on the Thursday's close, is that you can clearly see 71.30 here. That's close enough to $20. Think about it. But 93.30 was a high print. Somebody paid that, and this is what the bid is. So you can see the big contraction in the call side. You can see how the premium is worth a lot less money. It's worth a lot less money. And the protection side of the print, the put side that you're on, is going to cost people a lot more money, and it will. And then learning how, as an SMF market maker option expert pricing control operator, is how do I know to get the lower bid? How do I know which direction the market's going to go in? And what a capitulation factor would look like. And you could see that these contracts here could go skyrocketing in value still, and these very same contracts, if we had a capitulation, we'd be looking down around $15.50 bid here. All right? And we'd start looking at that market, which is significantly lower than the current supply and demand market between the bid and ask of the closing session Friday. However, the SMF options market making price model says that we start looking at it at around 15.5 should there be a qualifying capitulation that those contracts would start making markets, and that would be the place to buy. Should there be a capitulation, there could be, we don't know. We know what the qualifier is, and we're prepared for it. What are the chances of it happening? Who cares? But we do care about where markets could sell off based on a worldwide economic financial crisis event would be the qualifier. So let's stay in reality that these things do have to meet their qualifier, and the pro side of it and the con side of things, so that you're well balanced in where these markets would end up being and why markets go higher. So how can I get that, and why does premium go higher? Because the Nasdaq 100 indexes are very good trades, and the Nasdaq 100 is these 100 stocks right here in the Nasdaq 100. Every one of these stocks are in there. Okay? There are certain stocks that MMTs trade and execute their daily market maker skills on that are the higher beta ones, naturally so. And which group of stocks, meaning that what kind of stocks move the Nasdaq 100 and the fear indicator relative to making markets in the Nasdaq 100 index option trading, which are the main leadership within the 100 here. And you will have a workshop to complete, MMTs, and you will get together and you will go through them, and one of the qualifiers and a clue, the clue is, MMTs, is that the higher dollar delta, those are the ones that are going to be the ones that weight the fear indicator, and it's also going to weight the Nasdaq 100 component, because it's going to be those whatever amount of stocks. You might come up with 10, might be 7 of them, might be 15, who knows what it is, but that is your clue, MMTs. So when you meet in your Nasdaq 100 workshop, at that point you will exercise this particular layout here, now, and which stocks have the bigger dollar price movement, and that's going to be the deciding factor on how to be on a put side of the market and or on a call side. Okay? And yes, this side is getting inflated and this side is coming down. And it was all based on directional movements now. And those directional movements, once again, I'm going to show it here on the weekly, is you can clearly see you're closing on a diamond low, weekly diamond low on Friday. That's a weekly move. You can see 1 teeny, 2, 3 deltas. My goodness. That was a total of 3 times 98.76. Do the math. From the short down. Short down. See, every rally has been sold short. And these lows are now at risk. And if there is a capitulation, you will know by if the futures have to qualify close to 200 points down in the futures to qualify to even enter into this plan. So it's another case management scenario with the realistic finding facts conclusion that we're doing. MMTs, we have a 10-7 strike price component that we're going to be looking at when we evaluate our system. And what we're going to be looking at is we'll be looking at, let's say, the 2100 put below, that's still below the market, okay? Should we break down there, okay? Another one that we'll be taking a look at naturally is the 2050 area, okay, in a shorter term. Should there be a capitulation, it would look like these strike prices. And the 1022, which is already priced, you can see the 2135 is 76.55 on the last, and the 2135 over here, you can see the stats on the October Nasdaq 100 weighted calls and puts and open interest. See, so according to the directional movement of a capitulation, we would be looking at, well, how much money do they take out of this $2,100 call, and what does that look like on a weekly? And I can tell you that this $2,100 put rather is right here on a weekly. You can see that the high of the contract at one time was up here at $136 now. Let us not forget this part. High 136.20 right here at the pointer. Now its lows when it started that breakout there up to that level, look at it. It was $19.50. That was wholesale. And they peaked all the way up here to a high of 139 to that high. And then they came all the way back down here to 1820, which was lower than the other price. Let's make sure. Right here was 1950. Oh my goodness, 1820 is the low and $73 was the high. And that's on the put option. Now, if we were to capitulate, this very $2,100 put intraday would spike way up here and go back. That's part of the plan. And once again, if you take a look carefully at the other ones that we discovered over here in the 2155s, they're already in the money. And those were the ones that we were doing last week. So once again, you can see that the weekly put here at the 2100 strike does, if there was a capitulation to start in the opening bell, you would go up extremely back up high again. So when the markets were rallying, the put side went all the way back down in value. But now that we've started a new sell-off from that last upside rally, we're starting to build a bottom base in here. And if there is a continuation sell down program in this right here, in this weekly chart, if we're going to come down and test these lows, we're going to be looking at this half bar right here. And this is going to be 21, 24.78, and that was on 8/15 of 2011 because it was. Okay. And so when we're taking a look here at how we had ran up here 2244 area, and look, we were looking at 2200 puts before. These were the last part of this run in volatility. Now we're closer to neutral on the whole cycle, but slightly a little bit more negative. We got up to a point where we were at that area, but then it went back into its neutral negativity trend. And the weekly lows is that if we pop down here, then what's going to happen here is that this put option that you're looking at, so you pop down here, that means these weekly put options got a chance of popping back to 120 up on the high side. Okay? And you would have to meet the capitulation requirement, because if you didn't, then it's not valid. And once again, it would be your own self-destructive thinking. However, we're talking about market capitulations going into an October period, and they just ended the worst quarter. Now, generally, we're going to see if their enthusiasm comes back in and wants to buy up these equities going into the major earning catalyst that starts on October 11th, year 2011. Google will be out that week, but the following week, which will put us up into a different time bracket, is we start to get very, very sector by sector. We're going to find out what their public CEOs have to say. And the thing about it is, SMF has a CEO indicator that we built, and it will tell us exactly where they were 3 months ago and where they're at now and where they were 6 months ago. It doesn't matter. We developed it, and it's quite accurate. And on those earnings conference calls in October, you'll be doing that. But this is about capitulation. It's about opening and gapping down, and that each one of these lines are 98.76 as far as one price goes. And of course it'll change, but the thing about it is that's what the next week movement is, starting Monday, and how this call or put will break out and how the calls will go down in value. Okay, and how this whole component chain right here is going to work is, take a look at the 2150 that expires. Look at it. It's a different contract. It doesn't have much data, but it has a low of 28.50 and a high of $24. It's a big trade if you're getting wholesale down here and then giving it back to the public up here. So those are not 10.7. That's totally different. But take a look at the 2150 here. There it is. 40. Oh, this weekly move. You want to see a nice one? All right. Check it out. 36.45, and now the premium on that 2150 put that we went over, and this is what it's worth this last week. So if you're getting entries down there, that's up to the high of see 36, and if you had, you know, even if you only had one contract for 3600, you'd be doing okay. And that was the 2150 put. Their highs were over here at $151 a contract, for crying out loud. And they got wholesale here, even at 25.65. And then they popped, but they came back down, and that low was only 36.45 on the weekly low. But look where it ended up within the weekly trend of what? Once again, I'm going to conclude this video, MMTs, and I'm going to show it again. Here is the daily. See? I mean the weekly. And I'm going to show you one last time where you want to use a weekly deltas and set the alarms here, set one here too, and set one here. Alright? Kind of slightly below them. So if it does hit it, you're all going to be alerted. And now on the opening new weekly bell is how a capitulation would be a factor based on a worldwide event.